Jim O'Neill, former chief economist of Goldman Sachs, which first proposed the BRIC concept in 2001, recently proposed the concept of mint Mexico, Indonesia, Nigeria, and Turkey.
In addition, statistics from relevant authorities show that the rapid growth of world population since 1950 has occurred mostly in developing countries.
Yes, and this growth has been matched by more rapid increases in gross domestic product, and thus income per capita has increased in most countries around the world since 1950.
An increase in FDI may be associated with improved economic growth due to the influx of capital and increased tax revenues for the host country. Host countries often try to channel FDI investment into new infrastructure and other projects to development. Greater competition from new companies can lead to productivity gains and greater efficiency in the host country. And it has been suggested that the application of a foreign entity's policies to a domestic subsidiary may improve corporate governance standards.
Furthermore, foreign investment can result in the transfer of soft skills through training and job creation, the availability of more advanced technology for the domestic market, and access to research and development resources. Furthermore, foreign investment can result in the transfer of soft skills through training and job creation, the availability of more advanced technology for the domestic market, and access to research and development resources.
Mint's rapid economic development is also inseparable from the contribution of FDI. So what is FDI?
A foreign direct investment, FDI, is an investment in the form of a controlling ownership in a business in one country by an entity based in another country. It is thus distinguished from a foreign portfolio investment by a notion of direct control.
The origin of the investment does not impact the definition. As an FDI, the investment may be made either inorganically by buying a company in the target country or organically by expanding the operations of an existing business in that country.
For Mexico, foreign investments are mostly concentrated in towns neighboring the U.S. border, where many assembly factories are located, as well as in the capital. Thanks to its robust tourism industry, the Yucatan Peninsula also receives substantial foreign investment. Investment mostly comes from the United States and Spain, especially the banking sector. Sectors receiving significant foreign investment are finance, the automobile industry, and the electronics and energy sectors. After reaching $26 billion in 2016, FDI flows to Mexico slightly increased to $29 billion in 2017, according to the 2018 January Investment Trends Monitor published by UNCTAD. IBM, Coca-Cola, Motorola, Walmart, Inditex Group, BBVA Bancomer, Santander Group, Procter & Gamble, L'Oreal, etc. Also, 500 of the largest Latin American enterprises have a presence in Mexico.
FDI flows into Indonesia have been experiencing growth. In 2017, FDI investment in Indonesia reached $32.34 billion, excluding investments in the banking and oil and gas sectors, an increase of 8.5% from the previous year.
Utilities, machinery and electronics, industry, estate and pharmaceuticals. Singapore remained the largest source of investment, followed by Japan and China. Implemented by the Indonesian government between September 2015 and November 2016. The government has introduced 14 stimulus packages mainly focusing on deregulation, interest rate tax cuts for exporters, energy tariffs cuts for labor-intensive industries, tax incentives for investment in special economic zones.
The CIA Factbook highlights Nigeria's FDI stock reached $98.73 billion in 2016, a 3.03% increase from 2015. FDI stock abroad also increased to $13.71 billion, a 10.77% increase from 2015. Some of the country's main advantages are a partially privatized economy, an advantageous taxation system, significant natural resources, and the low cost of labor. On the other hand, widespread corruption.
Turkey was the second largest recipient of FDI in West Asia, behind Israel. The country has adopted a series of legislative reforms to facilitate the reception of foreign investment, such as the creation of Investment Support and Promotion Agency of Turkey, ISPAT, a showcase of the efforts undertaken to attract foreign operators. FDI inflows improved in light of the development of public-private partnerships for major infrastructure projects, the measures to streamline administrative procedures and strengthen intellectual property protection, the end of FDI screening and the structural reforms carried out as part of the EU accession process. EU member states are by the largest group of investors in Turkey.